This is the New Sky Bay Markets Debrief following the Federal Reserve's September 20th meeting 2023. So as expected, the Fed kept rates at the upper bound of 5.5%, meaning no change in the immediate interest rate levels in the United States. No real change to the policy statement given either, and the usual chatter in the post-decision press conference. The big headline you will be seeing, if you haven't already, is the update to the FOMC SEPs. And for a bit of context, these are FOMC members' loosely projected forecasts for what the economy will be doing in the future, and in turn, what monetary policy will be looking like in those regards. So this is by no means a strict plan the Fed will follow. These are simply personal projections from the FOMC members of what they see happening in the economy, and in turn, interest rate levels responding to that. And there were a couple of shocks in these SEPs coming out today, which have roiled markets a little bit, as anything to do with the Fed often does. So just to get into these figures, I'm going to go across to my screen here and show you. And yeah, let's start now. So here is the chart that's available on the Federal Reserve's website. And just to get into the data, what you need to know, what you need to look at, here's what you need to look at. First of all, for 2023, the last economic projections that are released quarterly, so the last one was in June, the Fed predicted in 2023 the US economy was going to grow by 1%. So the change in real GDP was going to be 1. Now, as of today, the Fed is loosely projecting 2.1%. That is double what they assumed in June, right? That is a big increase. Take it in. That is a significant increase, in GDP evaluation. They're also, to go along with the strength, they're also assuming that the labor market is going to be stronger with unemployment lower. Was at 4.1%, now at 3.8%. So lower unemployment, stronger employment measures. PCE inflation roughly around the same, slightly less core PCE inflation by the end of this year. But the big numbers that really are spooking markets right now are these four down here. And this is essentially what FOMC members are loosely projecting the federal funds rate to be across the next few years. And in June, no change for 2023, still at 5.6%. So one interest rate hike left, And in 2024, they're now assuming a 5.1% instead of a 4.6%. So this is an upgrade. The Fed is signaling here higher rates in 2024 and in 2025, meaning tighter financial conditions. So what this means for markets is that you should brace, or you should price in or factor in this sentiment that the Fed is signaling to the world today, that they are foreseeing interest rates are going to be a little bit higher than they've previously assumed, based on the back of the growth that they are now forecasting. The forecast was doubled from 1% up to 2.1%. Stronger labor market, inflation still stubbornly above target for the next few years, and to go with that, higher interest rates. So this is spooking markets a little bit, as you can see, or as I'm about to show you, I should say. So if we can go across to my screen again, I'm going to show you how markets responded to this data released today. So here is the T-bond market. You can see how bonds across the board here are just, they're having a bullish day, you can see here. But you see the big shifts happening here in the front end of the yield curve. This enormous spike here was when the SEPs came in, and markets realized that the Fed was expecting rates to be higher for longer. The 2-year, same again, an enormous spike here as the Fed says interest rates are going to be higher. and all the way down the yield curve, even towards the back end, you can see how markets are just pricing in higher interest rates from the Federal Reserve. And if you don't understand why higher interest rates equate to higher bond yields, I will be going into that at my end of week debrief. This I just want to keep as a bite-sized market analysis, kind of off the back of this recent announcement today. So bond yields are up. What you're also seeing here, this is just awful news for stocks as well. Here's the S&P 500 down in the dumps today, not having a good one, down minus 0.9% as of recording this video. But of course, the NASDAQ, which is far more sensitive to interest rates, is down even further at minus 1.5% on the day. So just absolutely tumbling here. But if you look across the quarterly time frame, here you see that obviously things aren't as bad as they look on the daily, but still not looking good. Yeah, markets are starting to price in now this higher for longer view that the Fed has, even though that stronger economic strength is being forecast. This goes hand in hand. This goes hand in hand with higher interest rates from the Fed. So it's sort of a bit of a backwards environment we're in right now, where good news can actually mean bad news. So that's the immediate debrief I'm going to be posting on this channel. For a more in-depth and more contextualized, stay tuned. I will be going through it on the Saturday debrief. But as your instant market debrief to be watched pretty much hours after the Fed press conference, that's the information you need to know. Thanks for watching. If you found this very, very useful, if you found any value in this, please consider subscribing. I'll be posting videos like this after every big data release, and also videos before every data release of what to look for, what to expect, along with weekly backwards looking and weekly forwards looking, more in-depth analysis moving forward. So if you find value in this, please subscribe, and I'll see you in the next video. Good luck.